Devang Mehta also joining us this morning. Let's take a look at some of the stocks in focus as we head into trade. Devang, should we start off with M&M and that fab move that we saw yesterday? We were trying to analyze this during close as to what led to such a sharp spike, whether it's on the back of things coming together for M&M, expectations of the recovery continuing. What could be driving the markets to really, buy into that with so much optimism?
Good morning. Thanks for having me on the show. I think clearly M&M yesterday was driven more by the news that the loss-making businesses would sort of be shut down, and also a lot of reintegration would happen into the business, and the focus coming into where they are strong getting stronger could probably re-rate the stock for some time to come. I think the business went through a lot of turbulent times over the last 2 years, not only because of the automobile cycle getting slowed down, but also a lot of businesses were sort of bleeding. So I think this seems to be a welcome move from the management, and I think markets has given it a sort of a thumbs up. But having said that, we still feel that a lot of demand which came during the festive season was more of pent-up demand. It seems to like this demand is not quite sustainable over the next 2-3 months. Of course, time will tell that. But I think the auto cycle, the auto shares went through a very difficult and a rough patch. This is more of a laggard rally which we are seeing in a lot of such stocks. So I don't see the fortunes changing for these companies immediately. But yes, some bit of re-rating and some bit of extended buying could remain in this type of businesses.
Okay, so M&M continue to see some sustained buying is what Devang says on that one. And couple of the other heavyweights as well that have remained in focus. RIL, Devang, where do you stand on a Reliance currently? It's been, a little quiet, but given the kind of move that it's seen of late on the back of all the developments on retail and otherwise, where do you now see the outlook for RIL?
Is in the news since last 4-5 months, and in fact a lot of deals made the street sort of actually re-rate the stock, and a lot of investor interest was seen apart from FIIs and DIIs. I think all the marquee investors which took a stake in Reliance Jio and Reliance Retail are here for the longer haul. So I don't think there is going to be much of a problem. Of course, the move was a little too swift for the people to digest. So I think it's just taking a sort of a breather. And of course, the oil and gas business was a little bit of a drag when the results came out. So I think it's more or less market which is seeing sector rotation and stock rotation. Over the last 2-3 months, we have seen all cyclicals also coming back. Your laggards like banks have shown a great move in the last 1 month. So I think it's more or less sector rotation which is happening. Again, the time will come for Reliance and other businesses when they will take the metal and take the market up. So it's more of a breather. And for people who are just left out, I think they would again reconsider entering it at lower levels.
Devang, another stock that I'd like to bring to your attention is HUL. Yesterday, the FMCG index had it fairly rough, and that can largely be attributed to the drop that we saw in HUL as well. 2140 is where it's settled at. While the company is looking to, up their game with new launches in the natural segment, home care, even hygiene, what's the road ahead for HUL?
I think HUL plus all the FMCG companies had also seen a breather or a sort of a rally which discontinued in the last 1 month. FMCG companies like Nestle, Britannia, all these companies, some of them came with great set of numbers in terms of even volume growth and in terms of even margin expansion. So I think the future ahead is extremely bright for this type of companies. They are so-called essentials in this difficult environment. Of course, as the market breadth has got a little more, I can say, thicker in terms of a lot of businesses participating. This companies, of course, trade at an expensive, I can say, a price to earning ratio, and they have deserved this over the last 5 to 10 years, and they get from expensive to being a little more expensive. I think there is a lot of investor interest in this type of businesses where you get stability, you get good night's sleep and peaceful returns. So I don't think FMCG is going to be a laggard for a longer time. It would again start participating in the rally, or in fact lead probably when there is turbulence in the market. So yes, HUL, Nestle, Britannia, all these types of businesses could probably come to the fore and do well once this high beta type of a rally sort of breaks down, or at least stops.
Okay, thanks very much, Devang, for giving us that take. Let's get a move on then and focus in on this interesting comparison between RIL and the Nifty. In fact, we understand that the market underperformance of RIL has contributed to denting the overall performance as well of the frontline index in the last 3 months. The blue-eyed boy, if you will, that's Reliance Industries, has dropped nearly 5% this month, while you've seen the Nifty rise about 14% in the same period. So what exactly is the correlation between the Nifty and the heavyweight Reliance Industries? My colleague Jayesh Khilnani has the details.
So one of the reasons that we are seeing the Nifty underperform is because the largest weighted counter on the index, that is Reliance Industries, that has significantly underperformed in the recent past. If you have a look at the simple ratio analysis of how Reliance's market cap stacks up in the context of Nifty's market cap, earlier in June 2020, we had pointed out that Reliance's market cap now contributes about 14% of the total Nifty market cap. That had surged to about 17% during the previous month. However, we have seen a significant correction of about 10 to 15% that Reliance Industries has undergone ever since. And the current ratio once again stands at about 14%. So in a sense, it is back to the previous breakout level or the historical high that it had touched in the last couple of decades. Just to show you how Reliance has performed against the Nifty in the last 1 month, the Nifty is up about 9%, while Reliance is down 9% in the last 3 months. Reliance is down about 5% as compared to Nifty's gain of about 14%. And since 19th of June 2020, when we had pointed this ratio analysis, Nifty is up about 26%, while Reliance is up just about 13%.
Okay, that's on RIL. Devang, I want to get your view on some of those metal majors as well. We've seen this phenomenal move in Tata Steel, naturally, of course, because of the kind of work they've done on cleaning up their balance sheet and what's happening in terms of efficiencies in the Europe business as well. But prices are on the up move and it looks like it's only going to get better. Would you stick to the frontline names, Tata Steel, JSW, SAIL even? What would you prefer if you're looking into that pack?
In fact, Abha, we always generally stayed away from metals and as such global cyclicals, or I can say Indian cyclicals as well. And why the reason for that should clearly be that whatever is a structural move in terms of a lot of sectors available right now at decent valuations, they would tend to probably give you a multi-year rally. Cyclicals like Tata Steel, of course, would depend more on the China situation or how the global world emerges out of this crisis. Yes, there is an opportunity over there for sure. The debt reduction, the plans which company had announced, there could be some bit of a re-rating which can happen because the stock is underperformed for a long time. So it would be more of a tactical buy for people who would probably deal into cyclicals. But purely as a portfolio stock, we wouldn't recommend Tata Steel because it's going to be extremely difficult to time the moves in terms of cyclical businesses. As cyclicals, if somebody wants, not as a cyclical, but somebody wants this type of businesses which can see a lot of traction, something like a building materials or cement would qualify as a much better play than steel or metal, which comes with a load of truckloads of debt in difficult times, which is difficult to sort of sustain or cost or those interest costs to sustain. So I think very clearly we would prefer something like a cement than steel.
Mm-hmm. Okay, fair enough. And I'll come back to you on some of those cement names. But Kunal, on the charts, let's take a look at Tata Steel, particularly after the move yesterday. Naresh, pardon me.
On Tata Steel, right?
Yes.
On Tata Steel, what we've seen is the move has been really strong after a breakout at 420s, then taking out further resistances, and 520 to 550 zone continues to be an area where it should pause for right now. Say going forward, any dips to 480 to 500 zone would be again a buy opportunity. On a longer term basis, we still believe it's a much longer term cycle, which is multi-months and could be more than a year or so. So it is never going to be a one-way rally given the sector is cyclical and there will always be a lot of skepticism. So the zone of 520, 550 is where we should see a pause and watch out for a dip, and that is where again another opportunity pops up on Tata Steel.
Okay, just want to walk you through what the aviation data Poonam was highlighting, and it seems that the domestic aviation market in India is still miles away from really recovery. And as per DGCA's latest data, based on the inputs coming in from domestic carriers, the aviation sector has seen a degrowth of nearly 50%, 57% actually, in the month of October compared to last year. Devang, what is your own view on whether or not this is a good contra buy? In fact, not just aviation, be it tourism, hospitality, multiplex, this entire theme, you think is good to be bought right now in anticipation of whenever the recovery comes in?
I think what has happened, Aisha, is the prices already have sort of shot up in anticipation of the economic recovery just around the corner, and also the unlocked trade, which supposedly has started 3-4 months back. And in fact, a lot of these businesses like multiplex business, if I can highlight, are still almost the theaters still being vacant. Of course, the cinema halls have opened up. But I think clearly here also one needs to focus on a balanced type of a portfolio. If one wants to play the economic recovery theme, it should be played via private banks, good private banks, a mix of retail as well as corporate lenders, which would serve the purpose a little more better than trying to gauge the economic recovery, which will or may not come. Why? Because we are seeing clearly a second round of COVID coming across the globe, particularly US and Europe. If this comes after the festive season in India, I think this trade again would go for a toss. So we are in for a more balanced type of a portfolio. One part of the portfolio has to be your FMCG, IT, great MNC pharma names, niche pharma names. And the second side can be banks, insurance companies, more of this type of companies, which also would be beneficiaries of economic recovery. Rather than being in an aviation sector, we know that people will be skeptical to travel for the next 6-9 months. We all are regular travelers, but have stopped traveling since last 9 months. So I think this travel and all will come back in 6 months, 1 year time, hopefully once this settles down. But there'll be better levels to enter this type of businesses, where already I think this has shown a lot of these businesses also come near pre-COVID levels, or are nearly around, I can say 15-20% just away from those levels. So I don't see a margin of safety over there.
Fair point. Devang, good to have you on the show. Thanks as always for taking the tower and joining in today.